over how your credit score impacts your actual mortgage rate. So all we're going to do on this scenario is change your credit score and show you how much your interest rate is impacted. That's why it's crucial to have your mortgage loan officer run your credit from day one. So this scenario, we're doing a purchase price of $400,000 with a 5% down payment, which is $20,000, giving you a $380,000 loan amount. It's for a conventional mortgage, so this is not an FHA loan. This is strictly for a conventional mortgage. Then we can go to the next screen. So all we're doing here is hitting next. Here we're going to put in your name, so we have the mortgage quarterback. Next. Here is the most important screen where we put your credit score. So for a one-family home, we're able to go down to a 620 credit score, okay, with a 5% down payment. Here we put in your liquid assets, which are your checking and savings accounts, your retirement assets, which are your 401k, pension, 403b, and your annual income. We then go down to the bottom and click whether you're a first-time home buyer. If you're a first-time home buyer, we click this off. Okay. Here we type the property type, which is a one-family home, primary residence in Hudson County, New Jersey. Okay, it's very important that we select what type of property it is so we get accurate pricing. Next. So now we're going into the marketplace and seeing in the secondary market where we are going to sell your loan to or potentially keep your loan on our servicing books, what rates are. So right now today, with us giving you a lender credit, okay, of $570 back towards your closing costs and not charging you any origination fees from processing, underwriting, application, commitment fee, or points, we're able to give you a 5.25% rate. And this does include our 1% commission on it. So remember, typical commission in mortgage banking is 1%. So in this case, $3,800 is included in this rate. Now, Franklin American is the best lender in the marketplace. Caliber and Freedom are number 3 and 4, right? So now we're going to go back to borrower, not change anything else. See your name's still in there, and then go to finances, or we can hit next. And we're just going to change your credit score to 640. We're going to hit next. Now remember, all we're doing here is changing your credit score. Now with a 640 credit score, as you can see, your rate is 5.125%. Now with a lender credit of $912. You can see how little bit that impacted. Now what we're going to do now is show you what a 720 credit score would get you on this particular property. So if we can go back to finances, change the credit score to 720, and hit next, and hit next again. Now your rate drops down to 4.5% with a lender credit of $1,129. Now let's just say, for example, you wanted a 4.25% rate. You're able to buy down your interest rate of $2,409, which is a one-time fee, which is tax deductible. It's prepaid interest, to get your rate from 4.5% down to 4.25%. So just from having a credit score from 640 go to 720, you're able to reduce your rate by 0.625%. Now remember, there's no magic here, it's just strictly based off of your credit score. Now we're going to give you the best case scenario. If we can go back to finances. Credit score, let's just type in 780. And next. And next. Now this is the best case scenario. Any credit score above 780, whether you're 780, 781, or 820, it doesn't matter. Now your rate has dropped down to 4.375% with a lender credit of $300 going back to you. So all these rate quotes are with no points, no fees, no application fee, no processing fee, no underwriting fee, no commitment fee. In this scenario, let's say you wanted a 4% rate, you'd be able to pay a one-time fee of $6,023, which would get you a 4% rate. Remember, that $6,023 gets you tax deductible mortgage interest prepaid and a lower payment of $1,814 per month. So if your payment's at 4% of $1,814 and your payment at 4.375% is at $1,897, $83 a month difference. If you pay $6,300 upfront, $5,723 upfront, you'll save $83 a month on your payment. So you would take $5,700 divided by 83. I'm guessing that comes out to about 6 years of having your mortgage. So if you're planning on keeping this mortgage and your house for 6 years, in this case, it would be best to pay the upfront discounted point to get your lower rate. So that way you're able to save money after you make your first 70 or 72 payments. So again, your interest rate is very important to pricing out your accurate rate quotes. If anyone tells you they'll give you a rate quote without having your credit score on file, they're lying to you. So when you deal with us, you're going to get accurate information and the proper education to make the best decision.